Good morning, everybody. It's Wednesday, January 3rd, and this is the AgYield War Room. Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop those in the chat area, and we'll be happy to get to those during the show. We also, yesterday, in visiting with a couple of folks that tune in every day to the War Room, if you have any thoughts or comments and want to, insert them into the show, that's also a good way to use the chat function as well. So more than happy to, have those discussions, and we welcome everybody's opinion. So don't just use it for, blanket questions and things like that. If you want to comment on things that are in the show, please feel free to type it in, and we'll include it. Overnight markets here real quick. March corn up a half, 464 and a quarter. March soybeans were down a quarter at 1273 and a quarter, and March Chicago wheat was down 3/4 at 606. Gentlemen, we had a nice conversation here earlier this morning just on, what are we trading right now? There's a lot going on. We got weather, certainly in Brazil that by all estimations seems to be, pretty friendly for crop production. A couple of really big reports coming up in the next couple of weeks. But we were talking, in terms of some ratios and certain things like that. So kick it over to you, Dust. I think you had some good points here this morning just on bigger pictures we head into the spring through the next couple months. What we will be looking at here.
Yeah, definitely. So, we have a lot of things we've talked about in this video in the morning regarding funds selling beans. They've come off of a pretty good sized long position back to neutral. And as we get into the new year, first day, we have quite a bit of weakness in both beans and corn, especially on the rains in South America. So, we've had some private estimates come out of Brazilian production, and they are all kind of below trend to start, right? Stone just came out with their numbers. What were the numbers again, Dan?
Stone came out 152.8, which was down from 161.9. So a pretty significant cut, given where we're at today.
Yes, and then we'll see what CONAB says on the 12th. But the point being is, the ratio has dropped, which means that beans have fallen to corn since, basically 30 days ago, right? Go right to the end of November there. We were at about a 2.78 ratio of July beans divided by July corn. As of today, we're at, multi-month lows at 2.64 to 1. And you think about, okay, in a high interest rate environment, beans were still carrying a $13 to $14 price through most of that harvest time frame. Corn was sub $5 most of that time frame. Growers know that storing beans is just a higher value contract for raising capital in a higher interest rate environment, paying down operating notes that are 8.5%, 9%. You're gonna see a much better return just on the dollars you get to pay down that loan on by selling beans over corn on that front, just from the carry front. We go back just to the WASDE numbers. Corn has a 14.7% stocks to use ratio. Beans have a 5.8% stocks to use ratio. That's just WASDE projection as of December. We know we had huge number of corn acres this year, too few bean acres. That leads into that big difference in the carryout numbers. So we're almost at a 3x multiple of corn carryout to bean carryout. Corn spreads have continued to widen over the last month. Bean spreads have continued to narrow. So we are at that point where it could be that we did see a lot more growers selling of their beans at harvest and beyond. And on rallies, it's going to be a little bit more difficult, in my opinion, for them to see a lot more bean movement on rallies than you would see on a corn rally for corn movement. I think there's a lot more corn out there that wants to be sold in bins than what is left for beans in bins on net. So it'll just be something to kind of keep in mind as we go into a very seasonal time frame for beans. We put it in our letter to our customer base last night. In the last 13 years, going into let's say Feb 23rd, like a late Feb time frame would be a March option expiration. Just looking at the March bean contract over the last 13 years, 11 of those 13 years, we see a higher trade than the first trading day of January. Right? Pretty strong seasonal. If you take all of those trading days and all of the last 13 days between now and that day, about 75% of the time it's higher than Jan 1, right? The first trading day of January. So seasonally, this is also a time where, we've priced in a bunch of this Brazilian weather, a bunch of Brazilian rains. We've hit new contract lows for the move, new lows, knowing the acreage numbers post June 30th, that is. You could see further washout just because there was a strong desire to be long beans, and maybe that's why we pushed down below $13 so freely, because guys are having to get forced out of longs. But it is a seasonal time frame where you just want to be mindful of that. I'm not too opinionated on anything. I just say I wouldn't be surprised to see the ratio rise. Maybe corn falls to beans, maybe beans rise to corn. It's not a prediction. It's just something to watch, right? I think beans don't move as freely as corn as we go into the new year.
Well, and a corn break in the new crop stuff from here, Dustin. I mean, we're already operating in a pretty margin tight environment for the new crop. I mean, by all estimations, costs are falling just a little bit. Rents seems to be flat to maybe even higher in some areas. But you drop below that psychological $5 number, which for the first time since, July that the D's 24 contract fell. It is concerning that if what you're saying, it's not a corn rally on the ratio, but rather a corn break maybe, and beans stay flat or rally a little bit. I mean, that's going to be pretty interesting makeup as you head into planting intentions and making that decision to plant corn or beans over here.
Yeah. I mean, I think, based on university data, the D's 24 contract is below cost production for the majority of producers right now.
Right.
A lot of sticky things like sticky inflation, like rent. I obviously are getting a break at nitrogen prices, but a lot of other things are still very elevated in costs. So a sub $5 D's 24 corn price, I don't think that attracts a lot of selling. You got to remember too, we had a red D's contract above $6 for a while, and that didn't attract a lot of selling.
Right.
So, to see a sub $5 price for a new crop, yes, it looks better than the 460s that the lead month contract's trading. But, from the May to D's contract, let's say, for example, that's only a 21-cent carry right now, which is a new low for that spread. But in terms of full carry, it's only about 30% of full carry in today's environment. So that's a really not a very wide spread. If we're thinking that the reason D's 24 corn is falling is because of excess old crop supply carried into that year, like we're going to have enough, 2.3 billion bushel carry in, let's say, to D's 24, maybe we can use some of those bushels we produce this year for demand in the next calendar year, in the 2024 marketing season. That would be the reason why maybe we won't see excessive producer profitability to get growers excited about planting corn. So we already have enough corn laying around from the prior year. I could definitely make that case, but the spreads aren't suggesting that right now. Spreads are moving in that direction. And maybe it's because of what we talked about at the start of this conversation. Maybe there's still a large grower overhang of bushels that want to be sold and haven't been sold yet. If that's the case, if that's what drives spreads to go wider, that's a concern. I'd say old crop, in my view, still has quite a bit of risk here as we get into where people actually are forced to start selling corn just because of the calendar. That would be, I know it's counter seasonal. Usually we see a rally this time of year, but if there was a lot of corn left over that wants to be sold, that is going to be an albatross in the market.
Sure. Ben, what do you got for us this morning?
Yeah, just to kind of echo Dustin's sentiments. In my opinion, we definitely saw more beans move in the fall. We're seeing basis firm up on soybeans a little bit as those supplies start to get depleted.
What are you seeing for basis, Ben?
Option to drive over processors in the east. Just slightly firming up a little bit here. There were some small basis pushes for corn yesterday, which leads me to believe, and you can connect dots however you want to in this business and be wrong at the end of the day. But I think that a lot of the corn that's on farm in the east is unpriced and unhedged because we had such a large crop here that you could very easily justify that people would move more corn on contract and store unpriced corn, hoping for a post-harvest rally, which really has not materially been realized. So it kind of puts the grower and the processor at a place where the grower is looking for something that they may not get. But I would certainly think that any sort of a rally where they could put together, $4.90 to $4.85 to $5 cash corn, I think that there will be willing participants to engage. So I think a lot of the corn that hasn't gone through the system yet is unpriced because we had a large crop, particularly in the eastern part of the Corn Belt, and logic would tell you that you would deliver on contracts above the market if you felt there was going to be the seasonal rally that that Dustin alluded to. So ultimately we've got to find a place where we do some export business and we do some aggressive export business, or we've got to see a fundamental shift towards commodities, which is the timing of that could be 2 months, it could be 2 years. You don't know how that's going to work out. And then certainly, I was on a call with a bank that I work with this morning, and they asked me specifically about geopolitical risk. And the way the question was worded, it was looking for, is it supportive? And geopolitical risk can be positive or negative. If you're going to take any sort of event and say that if A happens, B must happen, there's a good chance that you're going to wind up getting disappointed. So, I think the one thing that I look at and said that would be, I would see as overwhelmingly negative would be if we were to engage in any sort of trade war, as it starts to become more clear on what our election outcome could be in the U.S. So, there's a lot of things that can change this market, but until that point, we have to price in order to find demand. And yesterday was ethanol was down hard yesterday, with corn being down hard. Ultimately, everyone in this business is in a margin-based game, and those things will adjust to make margins to where they're palatable, and we have to keep that in mind. So I think that with the rebalance in front of us, should some strength materialize, it's a really good time to take stock of where you're at going into that report.
And that's the 5th through the 9th for folks that hadn't been listening or just tuning in. That'll begin, right, Ben? 5th through the 9th for the
5th through the 9th business days.
Yeah.
Yep.
Okay. Very good. Very good. Also, you mentioned ethanol, Ben. We'll get ethanol production out on Thursday. And then also this week, we'll have a delayed export sales report due to the holiday. So we mirror basically all the reports from last week, this week. No announcements the last couple of days, guys. Anything there? Holidays. I guess what do we see in inspections? We're pretty poor for corn yesterday, if I'm not mistaken. Dustin, yeah. I think you wrote about that a little bit last night.
Yeah, poor for corn. They were a little bit above expected for beans. So, yeah.
I look at that corn export inspections number, and I guess I'm a little bit like a lot of people. I'm trying to find something to grip onto, and I think I'm more interested in seeing what it comes out next week when everyone is back and out of the holiday mode and people are back in full force. I think anyone that works during the holidays realizes that capacity at a lot of places is greatly reduced. So,
except at AgYield, we're full-fledged, Ben.
We're full-fledged. The only other thing I would say in corn is that, it's the bearishness of corn may be the most publicized trade in all of commodity land right now. So we're probably going to have fits of short covering from time to time, but without any of those things change, the extension of those rallies will be limited.
Yeah, it's a really good point. Coming into the open here, fellas, any parting shots as we start out? Looks like we got March corn down a half, 463 1/4. March soybeans off 3 at 1270 1/2, and March Chicago wheat down a couple here at 604 1/2. Every day, guys, streaming live on X, Facebook Live, and YouTube Live. We'll be back again tomorrow morning, 8:15 Central Standard Time. We appreciate everybody tuning in this morning. Thanks for your comments, fellas. And we look forward to talking to you tomorrow. Have a good day.
Thanks, Dan.